This was me, March 2023, working a dead-end job on the side whilst grinding college, pursuing a job in finance. I knew that this wasn't what I wanted to do, but who really likes their job anyway? My real dream was to work for myself. That way, I make the rules, I say when I work and I don't work, and I take 100% of the profits. Well, later that month, I found something called Forex. It's all done from your phone or computer, and it's entirely based on you. You don't have to rely on anybody else. So if I put in the work and the dedication, then there is no way that this fails. So in the minimal time that I had between going to college and working part-time at Waitrose, I was grinding. And eventually I was looking down at my phone and seeing numbers made from one trade that Waitrose wasn't going to pay me in an entire month of hard labor. So I quit. And now I'm free. I can do whatever, wherever. The only issue is I need more people around me to be in the same position. If everyone around me is working a 9 to 5 to make the money that I generate in a day just by sitting on my phone, then what am I really up for? So I'm going to show you all exactly how you can print money from your bedroom, and eventually I'm going to make the coldest group of profitable traders and host the craziest meetups you're ever going to see. But the real question is, what is trading? Now, I'm going to be talking about Forex trading here since it's so common and easy to get into. In fact, you've likely done it before. If you've ever been out of the country to somewhere with a different currency to you, you've definitely had to exchange your base currency to whatever their quote currency is. So for example, if you're in the UK and you're traveling to the US, you've had to exchange your base currency, in this example the Great British Pound, into whatever their quote currency is, the US dollar. And with this, you have successfully traded Forex. That's really all it is, the foreign exchange market. So how can you turn this into a profitable income source? Well, let's say you have 1,000 Great British Pounds and you're exchanging it into US dollar. The exchange rate for that is currently 1.35. All this means is that if you convert 1 GBP into USD, you would receive 1.35 US dollars. So if you exchanged 1,000 Great British Pounds, you would receive 1,350 US dollars. However, this exchange rate is constantly going to be changing as the value of each of these currencies fluctuate due to whatever is going on in these countries. Inflation, interest rates, supply and demand, all these factors will change the value of a currency. If the UK economy is doing really well, chances are the exchange rate price will change. And if it's doing really bad, it will likely change a bit. Same with if the US is having fluctuations. It all affects the exchange rate between these currencies. So let's just say you've exchanged your 1,000 Great British Pounds into US dollars, so you now have 1,350 USD. And let's just say you keep that for a year, and the Great British Pound has a crash, or the US economy is just doing really good, and the exchange rate goes all the way to 1. So it's going to be a 1-to-1 conversion rate. If you now convert your US dollar back into Great British Pounds, instead of getting the 1,000 GBP that you initially gave them, you will receive 1,350 GBP. Because the exchange rate has changed, you have just profited 350 GBP. And with a little bit of modernization, you don't have to run all the way to the airport to exchange your currencies again. You can do it all just from one button on your phone. And no, you don't have to be a financial expert to know how to trade. I'm going to be showing you exactly how me and millions of others can predict whether a price is going to go up or down just by drawing a couple boxes on our charts. And starting off, we're going to need somewhere to see the current price of currencies. So we can start off with showing you exactly how to use TradingView so we can start printing some money. Okay, so firstly, we're going to look up TradingView, and it's going to be the first one just here. Next, we'll come up to Get Started, and just here, we're going to sign up. Obviously, it's just going to be an email and password, you know, really simple stuff. Next, you're just going to see all of the different pricing plans. You don't actually have to pay a dime to start using TradingView to make money, but a little later on, you may want to upgrade to the essential plan, but I'll go over why a little later. So now you can come up to super charts. Now, this may look super confusing to you right now, but I promise that by the end of this video, you will understand exactly what you're looking at. Firstly, we're just going to come up to this little symbol up in the top right, and that's going to be our watch list. TradingView just kind of likes to chuck loads of different random pairs and stocks into here to kind of try and cater to everybody, but we're just going to want to delete all of these. Half of these aren't even going to relate to us. What we want is going to be up here just by the plus. You're going to see loads of different categories. Stocks, futures. We're just going to want the Forex category for now. Now, you may not understand what this is showing you right now, but basically, if we go to the first one just here, this is going to show you the exchange price between the first currency, USD, and the second currency, JPY. These characters are going to show you what pair they relate to. So USD relates to the US dollar, and the JPY will relate to the Japanese yen. If we scroll down, you can kind of see that this is the case for all of the other ones too. I mean, just here, EUR is going to be the euro, and USD, once again, is the US dollar. If we scroll down just for a different example, AUD JPY, you've probably guessed it by now, but it's going to be the Australian dollar compared to the Japanese yen. It's going to be the same for all of the other ones, so I'm sure you understand. But what should you trade? I mean, there seems to be an infinite amount of Forex pairs, so how do you know what's going to work best for you? Well, this is entirely going to depend on your availability, since different currencies or pairs are going to be moving more in different sessions, which are essentially just different times of day. So the pairs will move the best when the main bank related to that pair is open. So when the US banks are open, the US pairs are going to be moving more, which is better, and this is going to be the same for every other pair. When the banks for the JPY are open, the Japanese yen pairs will be moving more, and so on. This is simply because more money is being circulated, and when more money is going around, these Forex pairs will be moving up and down more in exchange value. When you understand what session you'll be available in, you can then go and pick your pair which that relates to. So let's just say, for example, I tend to trade when the UK banks are open. I will pick a GBP pair, and once you click on this pair, you can see that it's going to pop up in the top right just over here. If we come up here and click on it, we can then see the actual chart, and this is going to be the movement for that pair. Just to make sure, it will also show it in the top left, as well as our time frame, but I'll get into all of that later on. Once we understand what we're trading and when we're trading it, it's all going to start to look a lot cleaner. So if we once again click that symbol that shows our watch list, it will also close it. And now we just see the charts for what we're going to be trading. The first thing I recommend to do when you're cleaning up your charts is going to be removing all of this. It is a good indicator to show when volume is in the markets. That's all this is showing, you know, influxes in orders. But if you know what session you're trading in, you don't need to see it on the charts as well. So we can just come up to the top left and straight bin that. Just click that remove button and it's gone. And it's already looking so much cleaner. Now, to understand what we're actually looking at, it's going to be a bit more complicated. But once again, I'm going to go through all of it step by step. So let's just start with what's on the screen right now. Up on the right side, it's going to show you the value of the currency and every other value that it's been at. This little green value here is going to be the current price of where we're sitting. I mean, markets are currently shut, so it's not the best read on it, and down at the bottom, it's just going to show the time and date. So the more right we go in the charts, it's going to be more and more recent, all the way up to present time. Then down at the left side, you're going to see all of the different tools that we use. I will quickly get some favorited so you can see exactly the tools that I use to make my money, and then I'll go about how I actually use them a bit later on. When you go into each of these sections, there'll be a little star, and once you click that on whatever you want to use, there will be a little pop out. It just makes it a lot easier to get to the next time you want to use it, especially for the ones that you're going to be using on a daily basis. So what I've gone for is the trend line, the rectangle, and the paintbrush. These two will just be marking out my trades, but I'll get into that a bit later. The further you go, you'll kind of understand what works for you. I mean, if you like to use different shapes to mark out different areas, you can kind of just do that yourself. But from the very baseline, this is more or less all I use. Now you have everything favorited that you're going to be using to mark out the charts. Let's actually talk about what the charts are showing us. If we zoom in a little bit, we can start to see clearer all of these. We call them candles or candlesticks. But for now, all you need to understand is the green ones mean that price is going up, and the red ones mean that the price is going down. As you can see, green going upwards, red going downwards. I mean, it's pretty clear to see. In simple terms, all you need to know is that green means buy and red means sell. Now, I'm no artist by any means, but this is literally just going to show us a more zoomed in version of what we're seeing up here. So I've gone through and marked this out. So as you can see, on a red candle, and I'll go through what candles and wick means in a minute, price is going to open at the highest point of this body. We like to call this filled in part of the candle body. Since we know that red candles like to mean that price is going down, from that we can kind of tell that it closes lower than it opens. Therefore, we can see that open is up here and the candle close is down here. And that is what the candle body is going to show us. So what are these little lines on the top and bottom? Well, these are going to be referred to as candle wicks. And this is exactly what's going to show us kind of a story of what happens during this candle. Since there is a wick above the open of the candle, that means that this red candle once was green, since green candles like to open and go upwards. All this is going to show is the buying power within a candle. So we were up here, but then we can see loads and loads of selling power, and we decided to come as low as this point before some more buying power comes in, and we closed somewhere around here, just for this example. And with this, we can kind of tell the story of every single candle going around. Just so we get a taste of all of it, I'll also go through the green candle. We like to open at the lowest part, since we know that green means we're going upwards. So we like to close higher than we opened. All this lower wick means is that's the lowest point we went to, and all this higher wick means is the highest point we went to. It's relatively straightforward. I'd recommend taking a photo of this just for something quick that you can refer to as and when. Another easy way of seeing it is these are complete opposites. Green candles open at the bottom of the body, red candles open at the top of the body. So now that we kind of have a basis on that, you're probably asking, how long do these candles actually take to open and close? Well, this is going to be entirely dependent on what time frame you're looking at, and that is going to be determined up here. Currently, you can see we have it set on 1 day per candle. So this means that every single candle you see, the duration of that is going to be 1 entire day. Now, if you do click up at this place, you can kind of just see which ones that you want to be working with. And let's just say I like to look at the daily and the 5 minute, and let's just say the 30 minute, for example. Just click all of these, favorite them, and they should all pop up just at the top, just for ease of use. Once again, TradingView really does like to make it as easy as possible to learn. So as we know, each one of these candles is going to take a day from the open to the close. Now, what's cool about time frames is any lower time frame than the daily is just going to show us pretty much the details of what happened within this. So if we go to the 30 minute, we can see that entire day just in more detail, and then once again to the 5 minute, even more detail. So each one of these is going to have 48 30-minute candles. You don't need to know that, but I'm just showing it how much one of these actually equates to when you're kind of going into the lower time frames. And I know this by 2 30 minutes mean 1 hour, and there are 24 hours in a day. So in simpler terms, and once again just trying to visualize it for you, this candle just here will equate to all of these candles that I've highlighted on the screen just now. And I'm not even going to try and do that on the 5 minute. Now, I just want to go back and actually show you kind of how it moves. And this is going to be one of the main benefits of the essential plan that I mentioned earlier. It is only around £20 a month, but starting out, you really don't need it, especially if money is kind of the limit to you. But this is going to allow us to go back in time, not to be able to predict the future, but simply just to see how the market was moving as you go. And this is going to allow you to test your plan and really just build it to be as profitable as possible. Just to once again try and make this as clear as possible, I'll go through it again, but go back in time to show it. So using the replay function, I'll just go back to here. I'll mark out this entire candle, just as so. And if we go into, let's say, the hour time frame, what we should see inside of it is 24 different candles, since 24 1-hour candles will make 1 day. It's really simple stuff. It is just trying to get that basic view on it. And now we have this marked up, we can go even lower. Let's just say 15 minutes. These aren't really time frames that I like to use, but it is just getting that view on it. This will just show us a lot more details on what happened within those 1-hour candles, and then even lower, even more details. You can go to as low as the 1 second intervals, but I really wouldn't recommend that. Now you know what it is you're looking at and the time that it relates to, but how do you know what's actually going to happen? Well, there are going to be 3 basic trends that you can use to kind of predict what the market will do. Now, these 3 different trends are kind of going to allow you to predict where the market wants to go. If the market is in an uptrend, all that's going to mean is that there are more buyers than sellers in the market, so you're going to be wanting to buy. In a downtrend, there are going to be more sellers in the market, so you want to sell. And when the market is in consolidation, it's going to be harder to determine whether you're going to be buying or selling. So it will be hard to predict what's going to happen in the future. Now, with an uptrend, we can determine this by seeing constant highs being made, lows being made, and then higher highs being made. That's what this HH means just here, as well as higher lows. The market will consistently make these, so you can determine that the market will come down and then break that high once again, forming another higher high. If I come back to the market that we looked at previously, we can kind of see this in play. The market makes a higher high just here, followed by a higher low. Then another higher high is formed, followed by another higher low. And with this, we can determine that we are in an uptrend. I mean, as you can see, we just kept going up. Once again, it's all kind of easy to learn. A downtrend is going to be the complete opposite of this. It's going to be a low being made, then a high being made, and then that low is broken, forming a lower low, followed by a high that doesn't break its previous high, meaning that's a lower high. It's all really simple. It's just understanding it to start with. I've got a super clear example back here that I'll go through. As you can see, the market is going to be constantly making lower lows, followed by a lower high, breaking the low, once again another lower high, then just continuously breaking the lows. We can literally predict that the market will keep going downwards when the market is in a downtrend. And that's why this is so important to learn starting out. And then for the last trend that you need to know, it's going to be consolidation. This is when highs and lows are going to be constantly matched. So you can kind of predict that the market will stay within this range. I've found an area of consolidation here that I want to show you. And as we can see, we go as high as this point just up here before coming down to here and then just repeating the cycle. And price just stays in this range. This is an area of consolidation. So after that, it's going to be really easy for you to kind of see where the market wants to go and see what you should be doing. In an uptrend, the market keeps rising, so you want to buy. Downtrend, the market keeps going lower, so you want to sell. And in an area of consolidation, the highs and lows will just be constantly matched. If we zoom in a bit closer, we can also see some areas of what we call support and resistance. And if I grabbed a box, once again, this is all just boxes and lines. That's all trading really is. We can chuck it here and see that this low didn't want to break this high. That means that there is some level of resistance where the buyers don't want price to get lower than that point. We call this an area of support. In this downtrend, we can see that this high didn't want to break this low. Once again, we can mark this out and literally just determine that this is an area of resistance. The sellers didn't want price to rise above this point. Since we're in a downtrend, we want to continue going downwards. So there will be resistance for the buyers. And then a lot of you may have guessed by now, but for a consolidation, there will be both a level of support and a level of resistance. And this is going to be where we're ranging from. Bounce off the support and then off the resistance. This isn't going to be a major part of my strategy specifically, but this is just going to give you a great read on what the market wants to do, so it's great to know anyway. Now this gives us a super baseline reading on the market and kind of how to predict it, but there is going to be two main ways to actually predict when you should buy and when you should sell. And these two different ways are going to be called the technical analysis and the fundamental analysis. Let me start with technical analysis. All technical analysis is going to be is literally what I've been showing you in this entire video. It's what you've probably seen when you see trading. It's going to be all of the lines and all of the boxes. That is literally what technical analysis is. Here we can see, as we just mentioned, a very clear downtrend. The market is going lower and lower. As we can see, the market is continuously making lower highs and lower lows. And to be honest, by marking out those two areas with a paintbrush, that is technical analysis. Some other ways that we can show this is by lines, and this can just show us that we are going downwards. We are literally analyzing the market technically. That is what technical analysis is. Similar for an uptrend, we can mark out where the price kind of wants to go within that move upwards. Also, what I did earlier with that consolidation when I marked out the range, that is technical analysis. I'll actually go over how I mark out my zones a bit later, but I'm just going to quickly talk about the other side of analysis, which is called fundamental analysis. Now, all fundamental analysis means is news. What is happening in these countries that is causing these currencies to move upwards and downwards? And the place that I think you're going to see this the easiest is on forexfactory.com. If we come up here to calendar, we can see all of the news that is happening at a specific date and time. And all of these will move the market in some way. But the ones that we really want to be careful of are the red folder news. This is going to move the market the most. And it's more or less stuff that you always just want to stay away from. I'd definitely recommend you go and check this out yourself. This isn't going to give us a huge read on where the market will go. It's more or less going to give us a read on when to stay away from the market, since this is going to manipulate it in a way that may be negative to you. For a quick example as to why these actually move the market, let me look at unemployment claims. All unemployment claims is going to be is the data of unemployment claims being released. Therefore, if these claims are rising, then people may have less faith in the economy, specifically the US economy in this example, therefore creating some drastic movements in the market. People get pessimistic, they start selling the US dollar. And this is exactly the kind of data that is going to be moving the market a lot. It is all just going to be the current optimism or pessimism of a currency, and that is what changes the value and changes the movement in pairs. This whole site is going to be similar to that analogy that I gave earlier. Instead of having to run to an airport, we can just use our phone to place trades. Instead of having to read a newspaper, we can now just use this website, and it condenses all of that into one place. And it just makes it a lot easier. All of these sites are trying to give this to you as easy as possible. It is just the baseline understanding that stops so many people. Now I'm going to show you the basics of supply and demand, which is my strategy to make money, and how I use it to predict where price is going to want to go from a specific zone. So as you can see, we see a lot of green from this area just down here. Now what this means is there's a lot of buyers getting in the market down here. Maybe they know something that we don't know, so we see a lot of green. What you need to understand is that history likes to repeat itself with trading. So if we've seen that a lot of green comes from this kind of area down here, then it's likely that if we come back down to there, we will once again get a lot of green, which is a lot of buying, which also means that we should buy. So let's go forward a little bit. And as you can see, it comes back down to this general area that we've seen all of this movement from before. So what are we going to see? Well, as you can see, we shoot off to the upside once again. So if we did actually buy down here, then we would have made a lot of money on this move. Now let me show you another example and show you how you can actually place your trade. Because it's all fun seeing how it happens and how it plays out, but how are you actually going to make your split of the profits? And I mean, that's the important part to us, isn't it? Well, once again, we've seen a lot of movement from this kind of area. You know, a lot of buyers coming into the market, and as we've explained before, it's creating an uptrend that is characterized by higher highs and higher lows. Higher high here, higher low here. I'm drawing this in green because, as you know, green means buy in trading. So we can see that we're in for buys. This specifically down here is kind of an area where a lot of buys have happened before. So I'm predicting that if price comes back down to this point, I'm going to want to get in and buy. So let's just see if that happens. Yeah, perfect. As you can see, we come back down to this point and it looks like we're going to want to go upwards again. Once again, I've laid down everything that you need to know to actually understand what's going on here. I gave you that kind of timeline of each candle, and we can see that playing right here. There's been a lot of selling momentum, so we sold into this area. But as you can see, we closed green. So all that's meaning is price came as low as this before a lot of buyers came in and tried to push price upwards before closing green. Now from this, we can see a lot of buyers are in the market already, and that should just give us even more confidence that we're going to go upwards. So we're going to try and place our buy position here. We're going to use this long position tool. Long meaning buy, and if you've ever heard the term shorting, that means sell. So we're going to want to buy or long, and you've likely never seen this before, so let me quickly go through what this actually means. This middle line just here, where the red meets the green, that means that we entered at that point. We can call this the entry line. So for a long position, this is where we bought. Down here at the bottom, we're going to refer to this as our stop loss. Once again, it's all just kind of technical fancy terms for saying something so much simpler. A stop loss is going to be stopping our loss from becoming too much to manage. So if price wants to come down and hit our stop loss, then that's kind of the area where we're saying that, okay, maybe I was wrong about this trade and I'm all right with taking this loss just here before price comes even further down and becomes too much to where we can really handle that loss. It is always worth using a stop loss. I need to emphasize that now. On the other side, we can see our take profit. And I mean, as the name kind of says, this is where we're going to be taking our profit. It's a place where we're happy with the money that we've made and we want to exit the position here to make that much profit. And that's actually how we make our money. We make our money by the price coming above our take profit. So now that you have kind of the basis of how you enter a trade, let's say we enter this trade when we close green, we can see that buyers are in the market. When it comes to our stop loss, we want it to be in an area where it's not going to get hit before we move in our direction. Because if it does, we will just lose money and not be able to take profits on the move. Therefore, just leave it some room. I mean, this is already quite a lot of room, but if you want to be extra safe, then just put it below our zone. So that means if price comes down below our zone, we're going to say, okay, maybe I was wrong and get out of the trade. And as you probably know, uptrends like to make higher highs and higher lows. Therefore, if we're going to keep going up in this trend, we can see that this high will be broken. I mean, higher high, higher low, higher high, higher low, higher high. That's what trend is. So if all of our analysis is correct, it goes straight through to our take profit. And that is how we make our money. Now, how do you know how much you're actually risking or how much you make? Well, this is determined by a term called pips. And if you actually hover over this position, we can see our stop loss amount or our take profit amount just down here. See that 17.9? That means we risked 17.9 pips, or for simpler terms, 18 pips. Now we're going to use pips to determine our risk, how much we make, like I was just saying. But when it's just saying pips, we don't really know how much we're going to be losing. That isn't a form of currency. We're going to be paying for stuff in pounds or dollars or rupees. Depending on where you are, it's going to be a different currency. We don't pay for stuff in pips. That is where a position size calculator is going to come in. Once again, it may look confusing, but all we're saying is this is how many pips our stop loss is. This is how much we want to risk. And this is the pair and whatnot. So as you can see, we're on GBP JPY. That is the pair that we are trading. Our stop loss is sitting at 18.2 pips right now. So that will go in our stop loss in pips, 18.2. Our account size, just for a nice round number, let's say we're on a 10K account. Our risk ratio is going to want to be 1%. That's always a nice round number to risk with. Maybe if you're not as confident on a trade, you risk a bit less. But that is just a nice manageable risk. So 1. Then if we scroll down, we can see with 18 pips, to risk $100, which is 1% of 10,000, we're going to want to use this many lots. Now I'll get into actually placing a position a little bit later on, but you just need to understand that pips isn't a majorly confusing thing. You just need to know that that is how we determine how much we're risking. You're never going to get to a point where you know how much you should risk for the pip stop loss. That's not really something that people do. Just use a position calculator. It is really easy. So in simple terms, that is how we make our money. If I hover over this right now, we can see the risk to reward ratio is at 5. That means that for how much money I put up, in this example, like I was just saying, we put up $100 risk. If it hits our take profit, we're going to make 5 times more than that, meaning we just made $500 from this trade. Or in other terms, just one trade like this is going to cover 5 losses. So you can really see how you can use this to your advantage to make this a consistently profitable income source. By this point, we know more or less everything we're going to need to know to actually start practicing making money from the charts. So it's about time I actually show you where we're going to be placing our trades. So you can actually start practicing, the risk management that we were just talking about and get a good feel for the psychology where I feel as though a lot of people may fall short. This is going to be the most important practice. So to do this, we're going to be installing MetaTrader 5. If any of you have looked into trading before, you've likely heard of it. It's where a lot of traders actually place their positions. So let's go about how we're going to install this. To install this and set it up is going to be easy as anything. So we're going to go to our App Store or Google Play, depending on what you're on. We're just going to look up MetaTrader 5. And it's going to be the first one that shows up just here. I've previously installed it, but if it's your first time getting it, I'm sure you know how to install an app. Just accept all this. It's going to give you an option for a demo account here. But if this doesn't show up for you, I'll go about how you actually look this up. So we're going to go to new account. Just use meta quotes because that is going to allow you to make a demo account just here. I mean, you just fill this out. I'll fill that out and talk to you after. All right, so now that's all made, I'm going to give you a little bit of a tour. This is going to be all of the pairs that it gives you randomly. It's similar to TradingView, just kind of chucks anything on. But in our example, we're using GBP JPY. If you click on it and click on trade, it's going to pop up this screen, and this is where you're going to enter your stop loss size and your lot size like we were just discussing before. And this is what the chart actually looks like. And I mean, just looking at this, you can kind of see why we don't use this for actually looking at our trades before we enter them. It's just really ugly and it's hard to work around. That's why TradingView is just so, intuitive, and that's where I kind of spend most of my time. This is simply for placing those trades. All right, yo, so as you can probably tell, it is the next day. The next thing I want to show you is how to place a trade and the pair that we've been looking at, GJ, was out of session when I was actually recording. Therefore, I was placing trades and it was getting no movement since the main bank of both GBP and JPY were shut. So I just waited until they were back open on the next day, which is today. So we can go through that now. So now we have every single app that we're going to need to actually place a trade. We're going to go onto TradingView and look for a setup. Now, at this specific time, there's not really anything shaping up that I would take or anything that's valid for me to take. But for example, let's just say this looks like a good place to buy. We have reason to believe that the market is going to go up from this area. So if I just zoom in, let's actually try and place one of those positions. If I put on a long position, draw our entry price, and let's leave some room for the stop loss. Once again, we don't know what the market's going to do at this specific point. This isn't like a valid trade. I just want to show you how you actually go about placing one. So the position lot size calculator that I found actually uses the entry price and the stop loss price. Like we talked about when I first showed you the charts, that's going to be the numbers on the right side of the screen. All right, so we just come to position size, obviously select our currency of the account and the pair that we're trading, which we've been looking at, GBP, JPY. Our account balance, when I made the demo, it was 100K. And firstly, we're going to need our entry price. Now, like I explained, this is going to be the middle line on one of these long positions. It's still currently moving. I'm going to be doing this a bit slow, so I might not get the best reading of where we actually are. Let me put in the price where it's currently at, 109.048. And then I'll put in the stop loss price as well. Once again, I'm just reading them off the right side of the screen. And then when we scroll down, we're going to see how many lots it wants us to place. Now we're going to be working in standard lots. So that was 6.24. Once again, we're still moving quite a lot and I am doing this slowly. Let me try and get a more accurate reading. Boom. 7.5 more or less. So we go into MetaTrader, choose the pair that we want to trade. And we're going to put in the stop loss price that we talked about previously, 198.814. And also the standard lots that it's said to use. So that's 7.58 standard lots. And simply press buy by market. That is literally going to just enter your position at that specific point in time. You don't need to wait for anything. And yeah, if we go onto the chart, once again, it is actually quite hard to see on MetaTrader. It's just not really used for the whole technical analysis that we were talking about. But we can see that we are in this position. Our stop loss is just down there. If I drag the right side of the screen, kind of squishes it a little bit. But yeah, we can see that we are actually in a trade. And this is where we're going to be making our money. When we're in a buy and the price goes up, we are actively making money. Once again, if I set a take profit as well, just going into this edit screen, then that means when the price goes above that, see, I'm already sitting 300 in profits. This wasn't really much analysis behind it, so I'm not going to take credit for that. But it does show like kind of how easy it can be. So yeah, as you can see a little bit above, that's going to be our take profit. If price comes all the way up to that point, that will automatically just X me out of the trade and I will make profits on this. But you don't actually have to wait for it to come up and hit your take profit. If there's a point in time where you feel as though something is going against you, maybe that's in your trading plan. That's not actually in my trading plan, but everyone's is really going to vary. It's just what works for you. I'll talk more on my trading plan over in my Discord. That'll just be down below. It's completely free, so don't feel as though I'm trying to sell you anything. Before I show you how to actually exit out of this trade manually, I want to show you what the term break even means. Break even is simply moving your stop loss to the entry price. Now we do this when we're no longer happy with taking the full loss, and it's just kind of taking all of the risk off of the table. It can be really smart to do to try and preserve our account's money, and it's a technique that I use along with a lot of other traders regularly. So it's good to know the term at the very least. So how we're going to do this is by simply putting our stop loss price to our entry price. And when you do that, you'll be stopping your loss where you entered. So you're not going to be losing any money on that. Since your stop loss is going to be 0 pips away from your entry. And as we know, pips is more or less used to determine how much we risk. I think that's the easiest way to say it. It's definitely going to be an experimental game when you're starting out. I've personally got rules that literally tell me when I should set to break even, just so I don't even really need to think about it that much. But when you're starting out, it's definitely going to be smart just learning how to execute those orders. Since to be honest, the faster you get at this, there's going to be less chance that price kind of shoots in the opposite direction before maybe you've modified your position to, put your stop loss to break even or something like that. also, for example, just fully closing out of your position, which I'm going to show you how to do right now. Let's say that I just want to exit this trade here. You know, I'm happy with making 600 or less on this specific trade, which is not bad at all. Maybe I'm not too sure that we're going to continue going upwards. Come to the three dots, close position, and we're simply going to want to press close, that orange button. And just like that, you've made money from that trade. That's really as simple as it has to be. You're not going to want to overcomplicate it when you're starting out. It doesn't have to be complicated at all. And this is literally going to build the basis for you making money consistently from your room. Now, every trading platform is going to give you different ways to enter a trade. And however true it may be that most people just want to enter the trade when they want to, some people like to automate it just that little bit more. Now, what you probably think is you press a button and you enter that trade. And that is going to be referred to as a market order. With a market order, let's say a trade is running and it's forming, and you think that price is going to go up from this point. You simply press one button and you're going to get into that trade. And it's going to be the same for a sell order. Let's say market is going downwards and you think that this is a point that we're going to continue going downwards. You're going to place that market sell order and it's going to get you into that trade almost instantly. Now, for buy and sell limits, it's going to be a tiny bit different. This is going to be a price. Once again, prices are on the right side of the screen, where you think that price is going to come down, and once it hits this price, it's going to want to come up. That's pretty much as simple as it is. You're confident that once it comes down this far, it's just going to reverse upwards. Once again, the same with everything in trading. The sell order is going to be the complete opposite of that. We're going to come up, and once you think we come up to a price, when we get to that price, we're going to go downwards. So that's just kind of a way to increase automation. If you want to be away from the screens more, I personally just stay on the market orders. And finally, I just want to talk about buy and sell stops. Now, these are essentially going to be the same as limits. However, it's going to keep continuing in that direction. So let's say that price is coming upwards, and we get to a point, you think that it's going to continue going upwards. Instead of having to come down from the top and then go upwards, you think it's going to come from the bottom and keep going upwards. And if you understand that everything with buys is going to be the opposite for with sells, you've probably guessed that a sell stop is coming down, you know, price is falling, and when it hits that price, it's just going to keep falling. Once again, you don't actually have to be at the charts to enter these kinds of trades. So if you feel as though something like this is going to help you with maybe psychology, then it's always going to be an option. Once again, I don't actually use these. I just stay with market orders. I don't feel as though I go out of my way to place trades. And I kind of like the personal touch. You know, I know what the market is doing when it reaches that point. There's going to be other things like rejections that we'll get onto a bit later on in your journey, which is more or less market behavior. And that's going to give us a really strong read on whether price is going to want to shoot off in the direction that we actually want it to. If you have any questions about anything like that, or maybe something a bit more personal, then there will always be the Discord down below, so you can ask me personally or one of over 300 like-minded traders that are already in there. Considering I made it pretty recently, I also want to thank everybody who has joined. It's grown to be a really, really good community of a lot of people that were very similar to me when I was starting out, so it is just great to see. I think all of you are in a great mindset, and I can't wait to see all of you guys progress to a point where you can turn this into a skill that makes you money consistently, because it really is so achievable. All you have to do is start.